Hey YouTube, so in this video I wanted to go over how long you need to keep your tax return data, right? If you've got returns that are a couple years old, can you just throw them away, never need to see them again, or should you keep them? So the IRS has kind of their rules around this, and then I'll give you my kind of 2 cents on what I would recommend you do, right? So the IRS, their website here, they've got a kind of a summary of the rules about record keeping, how long you need to keep the returns, what you can get rid of, and how the different years work. So the period of limitations, generally the rule is 3 years, right? So if you file a tax return from the date it's filed, you should keep it for at least 3 years. And the reason they tell you that is because that is the period with which you could either file an amended return to get a tax refund, or they can audit you. As soon as that period expires, then the year is presumably closed and the IRS can't audit you anymore. So it's 2021 right now. Let's say you filed a tax return for 2015 back in 2016. So April 2016, you filed it. That year is closed, right? Under the 3-year rule, the IRS can't go back and audit it, but that's not always the case. There's always exceptions to these rules, right? So what are they? Well, the first big one is you should keep the returns for 7 years if you claimed a loss from worthless securities or bad debts, right? And the reason why that's kind of been extended a little bit is because there's a lot of abuse there. People are writing stuff off that's not actually worthless. It's not actually a bad debt. It is recoverable. And so the IRS wants a little bit more time to kind of go after you if you put down something that wasn't accurate. The other rule, and this is a big one, is the 6-year mark. So the 3-year rule is overridden if you filed a tax return that underreported your income by 25% or more. So what would that look like? Let's say I made $100,000 in 2015 and I got $40,000 worth of capital gains from my brokerage account, and I didn't report that income. So I underreported my income by at least 25%. So the year that I filed for 2015, it's not a 3-year statute of limitation, it's 6 years, because I wasn't honest about reporting all of my gross income. So it's a 6-year period. The other big one is, and this is the real killer, is if the IRS can argue that there was any kind of fraud when filing the return. So if you intentionally omitted certain things, income, if you inflated expenses, there is no statute of limitation. The year can remain open indefinitely, right? So this is why, in my opinion, you should keep your returns forever, right? We live in the digital age. Just scan your old returns, save them as PDF, put them on a thumb drive. And this is because if the IRS is going to go back, let's say 8 years, and allege some kind of fraud, you want to have the records to defend yourself, right? You want to have the return that you filed. You want to have all the supporting documents. Now, granted, the fraud charge is an uphill battle for the IRS, right? It's going to be tough for them to show that unless there's overwhelming information that you were intentionally misrepresenting your tax position on the return. But nevertheless, it makes sense to just hold on to it in case that happens to arise, right? You don't want to have no information when you're fighting that kind of allegation. And then the last big reason I think you should keep your returns forever is because of carry forward items, right? So if you have capital losses that you incurred years ago and you're rolling forward those unused losses, if you start getting rid of returns from prior years, you don't have a record of the roll forwards. And so a lot of times I see taxpayers where they had carry forward capital losses, or maybe they were tracking their stock basis in an S corp or a partnership. They had unused passive activity loss carry forwards. You want to maintain as much of that prior documentation as possible to make sure the roll forward is accurate. Okay? If you start throwing items away, you're really relying on the most recent return to be the accurate representation of what the roll forward is. So rather than leave all that to chance, just keep a good record of it by saving all those tax returns from the prior years where you can see the progression. You can see how much is being added every year, and that ultimately you would, hopefully use in the future, right? Offsetting losses against future income, or if you dispose of those passive activity investments, it's a completely freed up investment at that point, so you can use the losses against other active income, right? So very, very important. Yeah, so that's the long and the short of it. The takeaway here is keep the tax returns as long as possible. Honestly, it doesn't make sense to start deleting stuff, especially if it's in electronic format. Like I said, if you have old returns that are in paper, scan them into PDF, save them on a thumb drive, save them on your computer somewhere, and then you can get rid of the original. That's fine, but just keep a copy of whatever was previously filed with the IRS, and then you should be good to go. Okay, so that covers it. Thanks again for watching, and please like, subscribe to the channel, and if you have any questions, leave me a comment below on the video. Happy to answer anything that you guys have as a follow-up to anything I noted in this segment. So thanks again for watching, and I'll see you again soon.